briefly about my career and what I've been doing for the last 35 years. Effectively, my career started in 1985 in the oil and gas industry, but it started from the financial side. And that financial side was as a investment broker working with accredited or million plus net worth investors who are looking for tax advantages by participating in domestic drilling. As a result of that beginning in my career, I ultimately developed my own licensed brokerage firm, and I had that firm for over 2 decades and created a very large client base that was actively investing directly in energy assets here in the United States. It involved everything from seismic acquisitions, exploration, production, saltwater wells, pipelines, pretty much across the board when it comes to the oil and gas industry. One of the things that I want to do today is I want to stress to a great degree that when you work with accredited investors, investors who have built up a net worth greater than $1 million, and you do it for 35 years, it's almost like having a PhD in entrepreneurship, investment portfolio management, and it also gives you a great deal of insight as to what the markets are doing and where the markets may go. So today I put together a short PowerPoint that'll walk you through where the oil and gas industry is today in the United States. In 2008, our country was running out of oil, and our production fell from 10 million barrels a day down to 3.8 million barrels a day. And the coincidental effect of that drop in price of oil was an all-time high for a barrel of oil, $145 a barrel. You and I were at the gas pump paying, $5, $6, $7 per gallon for gasoline, and it choked off the economy. In fact, it caused the dollar, the US dollar, to drop to an all-time low in the past 30, 40 years. It's down in the 70s. So the consequence of not having successful oil and gas is it affects your investments in stocks, your investments in private assets, it affects you in real estate. Now, as the screen shows you, everything you see in pink and dark pink are the brand new shale basins that you've heard about. These are actual reservoirs below the ground. I call them essentially like buried Grand Canyons. So when the oil companies realized these huge buried Grand Canyons were full of oil and gas, it took new technology, which was really developed in 2008 and 9, is what I would call truly commercially developed. They started drilling horizontal wells and using sand frac stimulations to crack the rock like a big sandblast or jackhammer, and that freed up all the oil and gas that they were expecting to find. That took us from 2008 until now, last year before COVID, to become the #1 crude oil producer in the world in less than 11 years. Now, this is what it looks like underground today. Oil and gas companies come out. They have very, very little effect of the surface. They drill small 2-acre pad sites. They'll drill down a well vertically. They'll turn it sideways, just like an underground plumbing in a real estate project. And they will drill horizontal wells 1 to 2 miles out in several different directions. They'll drill in several different formations that are below the ground. And what that has become is a massive underground system that allows us to safely and prudently produce oil and gas. Now, you as an investor may ask, well, this is all interesting, but kind of give me a financial correlation. Well, in the past, when you drilled a well straight down, you probably had somewhere around at least a 25 up to a 90% probability of a dry hole. So if you were in the drilling side of oil and gas looking for tax write-offs, you got a tax write-off, but you also took a big risk in drilling. Now today, if you participated in drilling, you're probably going to have about a 95+% chance of a successful well. Now, this converted itself into an opportunity into another sector, which is mineral rights. And the mineral rights are just exactly what you might think. And maybe you don't think that, but I'll tell you. Mineral rights are just like surface rights. They're real property. The Iras sees mineral rights as real estate. Therefore, it qualifies to be inside of a self-directed IRA. Ladies and gentlemen, we're not out of oil and gas. We won't ever be, that I can see in the next couple of 100 years. It's all about access, and it's all about the cost of capital. So let's just show you just a quick chart. Everything that you see above the brown lines has to do with new tight oil shale plays. They didn't exist before 2010. And everything from the beige or the fuchsia all the way up to the light blue, this is all oil and gas production that's now coming out of these shale basins that did not exist 10 years ago. So one of the reasons why oil prices have been fairly cheap the last 5, 6, 7 years is because the United States successfully has found all these basins. So with that being said, it also created a global problem in that the main suppliers of crude oil across the globe, which is OPEC, Saudi Arabia, and Russia, we were not only not buying oil from them, we started to export oil and take away some of their customers. That's why last year Saudi Arabia and Russia decided to flood the market together to wipe out the United States' industry, with the idea that Saudi Arabia and Russia are sovereign countries. They use their government in order to finance their oil and gas, whereas the United States is a private sector. Today we have 13 million barrels of oil was being produced last March because of COVID, because of drop in demand. We dropped below 10 million barrels a day 2 weeks ago. So what we've seen is just a slight interruption, what I call a black swan event, occur last March. And that black swan event, which was Saudi Arabia and Russia's flooding the market coupled with COVID, we saw the oil and gas industry in the United States get absolutely crippled. With all of that chaos created opportunity, and I'll get to that in a minute, but it created opportunity. But I want you as a consumer and an investor to understand two significant things have now happened in the oil and gas industry. One, the oil and gas industry lost about a third of its participating vendors and partners and service companies and oil companies, which means there's 1/3 less companies to go find new oil for us. We also consume about 21 million barrels a day. So we were producing inside the US about 60% of what we consumed. Now we're down to about 50% of what we consume. In other words, we're going backwards. That puts us in a very precarious position, because regardless of what anyone wants to think, you're not going to drive down the highway with the windmill on your hood and a solar panel on your trunk. The fact is, hydrocarbons are here to stay, and there's no way around it. The question is whether we buy it from somebody like Saudi Arabia or we produce it inside the United States. All right, so when we look at negative $38 last March, that was purely a trading day. But what it did was it set a new barrier. The new barrier said that because barrels of oil are traded openly on a futures market, that it does make a very precarious financial scenario. And so my 35 years in history, I've never seen a negative barrel of oil. It didn't last more than a day or two, but it sure sent a signal to all of the oil and gas capital providers. And this is the thing that is the second item I was going to tell you, which is the capital markets have essentially decided oil and gas is too risky, and the dollars that invest in the oil and gas industry have pulled out about 24 months ago, and even accelerated that pullout last year. Now, why is that important? The 100 million barrels a day that we use, there is no more. So every time we burn 100 million barrels a day, that's 100 million barrels of less crude oil on the planet Earth. That makes this a very unique commodity. It makes it a very, very fungible commodity from the standpoint there is only so much at a given price of extraction before either the people drilling for it decides it's uneconomical, or the consumer has to pay more to encourage exploration. In the next 36 months, I believe it will actually go higher than the previous high of $145 a barrel for two reasons: rising demand and no capital for oil companies to drill enough wells to keep up with that demand. So it's going to create a nice perfect storm. So again, Saudi Arabia and Russia figured out real simply, the United States' underbelly is debt. So every time that we start getting a little cocky and produce a lot of oil, every time we start taking away their customers by exporting oil, they come in, they flood the market for 60 or 90 days. Oil companies can't pay their bank. The bank's guided by the SEC and the feds. They say you're now out of covenants in your loan. They start calling the loans in. Now the pattern is every 4 to 5 years, we're going to have a flood of oil coming from some of the outside the U.S. producers, which in turn tries to slow us down, because the last thing Saudi Arabia, OPEC, and Russia needs is their number one buyer, buying 8 to 10 million barrels of their oil per day, decides we're now capable of producing our own 20 million barrels a day, because what that means is they don't have really anyone other than Asia to sell it to. And we have been selling our oil to Asia as far as in addition to our own consumption. So this is not a small thing. This is a country-saving economic consideration that OPEC and Saudi makes. That's why for us as investors in oil and gas, we have to know two things that are clear. We consume twice what we produce. We have a threat that is real every 5 years, which means that within the oil and gas exploration industry, the companies that have to use money to drill wells, they're always going to be subdued or held back, because they know the threat every 4 years could wipe them out. We'll never get full throttle on exploration, which means we'll always be short the amount of oil and gas we need to provide for our consumption. This is a great position. Economics 101, rising demand, shrinking supply, economic barriers to entry. It always provides for a great market. So let's see what it does. So capital is moving out. There's a lot of push to get into green energy. There's a lot of pensions, and there's a lot of institutional capital that says, hey, look, we're going to have to embrace this new Green Deal. We've got to be carbon neutral, stop investing in Exxon, stop investing in exploration and pipelines. We've got to go and do what the consumer believes is the right thing to do. There's a lot of social pressure. So now all of a sudden, Exxon or some of these major oil companies are going out looking for new money to pay off old debt or to have new money to drill. And they're being told, It's just not going to happen. I'm sorry, we're not able to help you. We're going to reduce your line of credit. So with that being said, every barrel we use today has likely 25 to 30% less new barrels to replace what we're consuming today. That is a great thing for you and I if you happen to own a producing oil well or producing minerals in this country. You'll have one of the largest, most valuable assets because it takes all of our oil and gas to run every company that's on the stock exchange, and every single asset that you're involved in is evolving around and started from a barrel of oil. Okay, so how's it going to affect us when we start looking at how total energy weighs on the economy? Well, we're already up, what, 50, 60 cents a gallon in some places, maybe as much as $1 per gallon on gasoline. Well, that's actually coming right out of the expendable consumer dollar. So as an investor who's looking at putting money into my self-directed IRA, it offsets some of the more public things like stocks and public equities, because when they fluctuate going up and down, generally hard assets and commodities do very well. All right, so let's talk about where we're at in the economy. I think, one advantage by talking to wealthy clients all day, every day, and my clients range from $2 million net worth, and I've got a client worth $2 billion, is that it seems like we're about to see a domino effect. And the domino effect is the economy grows when there's cheap capital. The economy grows when there's cheap energy. If you have a rising cost of capital and you have a rising cost of energy, it starts to eat up that discretionary money. And that discretionary money means you buy less boats and cars and toys and vacations. And now you're focusing on the fundamentals, which is mortgages and car payments and health insurance. So we're starting to see a changeover because of COVID, where we're now in kind of what I would determine to be stagflation. Stagflation is no growth and rising cost. Price of lumber is up 100%. Price of copper is up 48%. Real estate here in Dallas, Fort Worth is probably up 38 to 40% in 12 months. These are not small numbers, and it is macro in terms of how it's affecting the economy. The dominoes are falling. Now it's time to start planning. So how do we plan? Well, inflation's here. It's coming. They're claiming inflation's at barely 2%, but they're not counting food or energy, which is ridiculous. If you add in all components of the market, I've got people that I talk to that are experts in the economy are saying we're probably running closer to 6 to 8% inflation. That's a great thing for oil and gas because oil and gas causes inflation and it benefits from that. The dollar will sink, oil will rise, discretionary income will be less. Those who own oil and gas direct interest will do very well. Those who do not will be on the other side as our customers. So now you have this kind of catalyst that's moving in the direction of raging inflation. And I do believe we're probably 24 to 36 months to see what I would determine raging inflation, which is better than 7.5%, 8%. That little Amazon box showing up at my wife's front gate every day is not going to come free when oil gets to $100 a barrel. They're going to have to adjust their service, like a certain dollar amount, a certain size. They're going to say, we'll deliver twice a week, not every day. So the reason why it's worked so well is because they've had cheap fuel. When that oil price goes to $100 a barrel, it's going to change significantly your Uber rides, all these Uber Eats, everything from, like I said, Amazon. And that is where you start to see those who own oil and gas reap huge gains, big returns, whereas the rest of their portfolio may not be doing so well. All right, so the other part of the economy is that we had a president that was talking about spending $2 trillion in infrastructure. The current administration is talking about $3 trillion in infrastructure. And what that tells me is that you're talking infrastructure and manufacturing means a rising demand in oil and gas consumption, because you're not running that crane or that backhoe, you're not paving highways, you're not building bridges without a tremendous amount of increase in demand of crude oil. So the oil and gas industry is really technology driven. What they focus on is using the same type of GPS software where they send spacecraft out to outer space, where they send the Mars missions. We're using guided GPS tools that will go down 1 to 2 miles in the earth vertically. The drill bit and the guidance and all the electronics turns that drill bit sideways. They go out horizontally 1 to 2 miles. They then use modern technique to stimulate the formation through sand fracks. Everything about oil and gas today is run off of software and hardware, everything. They literally have people sitting in Houston, Texas, watching wells being drilled in North Dakota, Wyoming, Colorado, Oklahoma. Because of that, they're able to perfect their method. They're able to perfect the technique. And I'll give you an example on the screen that shows you. So here's a well drilled at the top of the screen on the left side. It was drilled, and after 87 months of being online, it made about $4.7 million in revenue, 87 months. They advanced the drilling, they advanced the fracking, they advanced the technology. And in 2019, that same exact caliber well made as much money or more money in 5 months. Let's talk about how mineral rights compare to traditional real estate. And the chart's there, you can read it. I don't have to go line by line, but let me just tell you what it's like. The Internal Revenue Service is clearly the eminent expert on what is or is not going to work or lose money. Why? When you drill oil and gas wells in the United States domestically, there's a 100% tax write-off against your gross income, because up until shale drilling, the IRS fully believed you had a chance of a dry hole. So we're going to reward you, Mr. Wealthy Investor, to participate in domestic exploration because we're running out, and we're going to give you huge tax write-offs in order to encourage you to do that. But now that we're running 98% success ratio in drilling horizontal wells, now the current administration is saying we don't necessarily need those tax write-offs. We may consider reducing them or maybe eliminating them. I don't think they will. I think they'll talk about it, but they won't do it because we do need domestic exploration. When you own mineral rights, you don't get a tax deduction because it's truly real property. It's deeded in the courthouse. You own it. It's got all the legal descriptions. And what happens is when you look at the value of owning a mineral right, you say, all right, let's look at the attributes. In the state that we're in, Oklahoma, you don't pay any property taxes. Certain states you do. There's no monthly expenses. I have zero capital costs or zero liability when it comes to liability. There's no property maintenance. There's no management company. There's not landscaping. I don't have sheetrock. I don't have tenant improvements. Accounting fees, very minimal. You get 12 checks a year, 1 check per month, and at the end of the year, you get a 1099. It's pretty easy. I just have to hope I don't get a paper cut, flip and open the envelope to sign and endorse the back of my 12 checks. There's no repair and maintenance. The oil company is responsible for 100%. No insurance, no rehab, no utilities, no environmental, no liability. In other words, we're the top of the food chain. And every single privately held mineral right, not on federal lands, privately held, which is all we focus on, we are absolutely top of the food chain. The good thing about oil and gas minerals, especially where we are buying minerals, is these wells are expected to have a commercial financial life between 25 and 50 years. Well, if I'm 50 years old and I want to put assets in my self-directed IRA, I want to open an account with IRA Club and with Dennis, I want something that's going to generate a whole lot of income. I don't want to have to worry about paying the taxes. I want it to last a long time. I want it to last long enough that it goes past when I start pulling money out of my IRA, and I'd like the opportunity for those assets to go up in value. That's exactly what mineral rights do for you. So let's just recap it. Why minerals and why self-directed IRAs? Well, the number one rule is today, I hear this from one wealthy partner after another. It is about taking control of your own assets. Minerals are held in perpetuity. I can assign them out to my grandkids. I can keep them in my estate. Some of these mineral owners have owned them 100 plus years. All of the natural resources below the minerals that we acquire are ours. If there happens to be water there, gold, nickel, in most cases, it's mainly petroleum or fossil fuels. But I'm just saying when you buy a mineral right, you own all the natural resources. It is passive income. All you do is get 12 royalty checks a year and 1 1099 to report your income. 15% is tax-free. I already went through the liability. The growth of the assets are simple. Every time a well is drilled on one of our minerals, we end up having additional reserves. We have proven producing reserves. Those reserves might be 500,000 to 2 million barrels per well, which means that as we're getting our revenue every single month, the buyer, if we decided to sell one day, is going to value our minerals based on the number of wells, the cash flow that's generated, but also they're going to look at the amount of oil and gas reserves are in the ground. And these sophisticated mineral buyers will look at us and say, hey, Troy, you paid $100,000 for your minerals in 2021. You now have 10, 15 wells online. I'm going to pay you $180,000 for your cash flow, another $100,000 to $200,000 for the reserves in the ground. 3 years later, I pick up $200,000 to $300,000 for what I made a $100,000 investment. This is why private investors like myself invest in minerals. We get cash flow, we don't have any expenses, and we have asset growth by the reserves that are proven in the ground. The other thing I like, we only buy minerals under what we believe are billion-dollar plus oil companies. If I want a Fortune 500 real estate portfolio, I'm going to go after Exxon, Chevron, Marathon, Continental Resource. I want to go after billion-dollar oil companies that will not only drill wells on the minerals that I've acquired, produce the wells that came with the minerals when I did acquire them, and they're going to develop those minerals over the next 10 or 20 years because that's what they do is they book reserves to build their own value for their company. And then at the end of the day, I want to know I'm going to get paid. I want to know that whoever is drilled and developed my minerals always is a company that has established decades of responsibility, accountability, and reliability by paying out their mineral revenues. Oil and gas is not a difficult business, but there is a lot of unscrupulous characters out there. It is also a risk reward. If you want to get tax write-offs, you got to drill a well. That means you also take a bigger risk. If you want purely income, then you maybe want to just buy minerals because at the end of the day, there's no expenses and no exposure to cost. So really, there's a great way to be involved in the energy space. There's a great way to do it through your self-directed IRA, open an account with IRA Club. And there's also a lot of management here at our company that can help you better understand the details by calling our 800 number, asking one of our wealth management team to talk to you about your portfolio and what works. But the main thing is about educating yourself in this particular industry and this particular space.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.